Hey, Dan Passarelli here. Well, we had another up day in the market with the S&P 500 closing up 0.4%, 0.4% that is, with SPY closing at 665.17, albeit in a volatile session. Why was the market higher? Well, mainly because there were strong bank earnings. Let's look at Bank of America. They killed it today. They were up over 4% with a nice big gap higher. And Morgan Stanley, they were up 4.7%, almost 5%, with a nice big gap higher, although that was a pretty volatile session as well on really massively higher volume. Another thing I'd like to talk about today is managing covered calls. Now, I had some covered calls against long stock that I had in Amazon, and I was short the 240 strike. Now, with all this market volatility, Amazon's implied volatility was pretty high, but yesterday I was able to buy them back at 5 cents, the 240 calls that are going to expire this Friday. I bought them back at 5 cents, and then I said, well, which calls should I sell? And I look at the chart, and I definitely wanted to sell towards the top of this range. There are some concerns about the market, but earnings are expected to be good, so who knows which way it's going to go, right? So I wanted to at least sell kind of at the top of this range, the 240 strike. And hey, if I can get a little bit more room to run, wiggle room, I'll take it. So I started looking at some of the strikes. And so I went like 235 to 250. Started looking at some of the strikes and I thought, well, okay, if I'm looking at the 9-day options, the 240 calls, I can't really get anything for those. If I go out to October 31st, look, the implied volatility is significantly higher. I wonder why that is. Well, I know why that is. It's because they have earnings coming. A lot of times when a stock has earnings, it makes me kind of dial back my covered call cash secured put trading, but I do have a trick or two that I'm going to share with you today on how I think about covered calls and cash secured puts going into an earnings event. So because I couldn't really sell the 9 strike at the strike I wanted, I started looking at these October 31st and the 240 calls I could definitely get enough for. I actually did this yesterday. Where did I sell? Well, I'll tell you which strike it was in a second. I could definitely get enough for the 240 calls. I could probably even go a little bit higher, 242 and a half, maybe even 245 calls with plenty of wiggle room. Now the 245 calls, which incidentally are the ones that I sold yesterday at, what was that, $1.90. The way I look at it is 245, I got my handy dandy calculator here, 245 minus the stock price, so yesterday is about 216, say, is $29 divided by 216. That would be a gap higher of 13.5%. So I looked at what some of the previous gaps in Amazon stock were on earnings days. Now, we're still a little bit off of earnings, and there's going to be some volatility before then, so this is not a very precise science. But as far as the gap going from the time when earnings closes to the morning after earnings opens, the biggest gap in the last couple of years was 9.6%. And the second biggest was 7.3% and then 6.7%. So if the stock were here the day before earnings, which is still not for another couple weeks, we'd be totally fine on those 245 strike calls because it would need a 13.4% gap. So in reality, the stock could actually trend higher another like 5% and I'd still probably be okay selling the 245 strike. So this is kind of how I look at it. I definitely prefer to maybe not have a covered call or cash secured put going into earnings, but I felt that is far enough away, not just because I felt it, but because I went through and I did the math on how far of a gap would be expected versus how far I think, based on how the market's going, the stock might be able to head up before earnings, and gave myself plenty of wiggle room. I hope that little tip helps. This is Dan Passarelli, Trade Smart.